Have you ever wondered what credit really is and how it affects you? In this video, we're going to break down what credit is, why it's important, and how to even use it. I'm going to be talking about my personal experiences and how it turbocharged my finances. We're going to touch on the basics of credit and the different types of credit applications. We're going to be covering what interest and APR means, and by the end of the video, you'll know exactly how credit works, how it affects you, and most importantly, you learn exactly how to get the best deals on loans for a car or a home. So why would you want to use credit? Well, maybe you don't have the money to buy what you want today, and you want to use credit because it's either a good deal or maybe you just won't have that money saved up for the time you need it. So take, for example, a car. If you wanted a car today and you only have $500, it might be better for you to finance a $5,000 car today and make payments on it than buying a $500 car when you only have $500 in the bank. If you spend all your money on a $500 car and it just needs, say, tires, that might run you $400, $300 for tires that you don't have the money for. That may be one reason you want to buy a car today and make payments on it over time. I was able to travel the world using credit and fund a few different businesses. I started a motorcycle dealership in about 2019, and I was able to do that with less than $10,000 to my name. By using credit, I was able to start earlier and use how much credit I had available as a way to leverage my money and buy what I needed today to make more money to pay back what I borrowed. So let's talk about the few different ways you may see credit. You may see it as a credit card. You may see it as a car loan. There's also home loans, and there's personal loans. Let's start off with a basic credit card. So what is a credit card? Think of your debit card. Every time you swipe your debit card, what happens? Your bank balance goes down. In terms of a credit card, you'll start your balance at zero, and every time you swipe your credit card, your balance goes up. So if you go to 7-Eleven and buy some Sour Patch Kids, that $4 that you swipe on your credit card makes your balance go from 0 to $4. You can keep swiping your card away until you hit your credit card limit. At that point, you're not allowed to spend anymore and you need to pay your balance down. So let's say, for example, you have a $500 limit on your credit card. If you have a $300 balance after 30 days of opening it, which means you spent $300 so far, you'll have to make a minimum monthly payment. That number will depend on the bank you have, but let's say in this example it's $30. So in order to keep using your card and be in good standing with your bank, you need to make a $30 monthly payment so you can keep using the card. So let's move on to car loans. So what's a car loan? You go to a dealership, you tell them you want to finance a car. Cool. So you buy this $15,000 car. You're agreeing to make payments on it. Say you agree for 48 months, 60 months, 72 months, whatever you like, whatever works with your budget. You're making an agreement with the bank that you're going to make payments on the car until the car is paid off. And in many states, you don't even get the title until you pay off your car. I know in Texas that's how it is. Let's say, for example, you buy a $15,000 car. You're going to make payments on that for 60 months, say $280 until it's paid off. What's cool is you could pay it faster and pay less in interest, but we'll get you interest later on, so keep watching. So let's take a house mortgage, for example. So unless you got boatloads of money lying around, most likely you're gonna have to get a mortgage. So the average property value in America is $416,000 according to Zillow. So if you wanted to buy that in cash, more power to you, you can definitely do that. But if you want to get a mortgage like most people, you're going to need to put a percentage down, 3.5%, 5% of the total price of the house. And then you're going to make an agreement with the bank that you're going to keep paying for the next 30 years until the house is paid off. Now, in terms of a personal loan, it works similar to a credit card, but they're going to give you the entire loan amount up front. So say you want to do some renovations on your house. You can go get a personal loan and they'll give you, let's say, $10,000, and they'll give you 24, 36, 48 months to pay it off. You could pay it as fast as you want, but you have the entire agreed upon term to pay off the personal loan. Banks are in the business of loaning money out. If a bank is not loaning most of their cash reserves, they are underwater. They need to loan money out to make a profit to stay open. Banks are like big money stores. They need to loan money out. And all credit is how trustworthy are you? And if banks see you as trustworthy, they will give you the money you ask for if they know that you'll pay them back. If they have almost a guarantee that this person with such a good credit score will pay them back, they will give you as much money as you need. So I want to give a huge disclaimer that you do not need to use credit in order to be successful. And quite honestly, I could just be stupid and not know how to live life without credit. That's very possible. There's many people that I admire, like Dave Ramsey or a few other business guys that never use credit, and they're doing just fine. I personally like to use credit for a lot of situations, but I have seen many people use credit and it hurts them bad. If you don't know what you're doing with credit, take all the time you need to get informed before you start swiping your credit card, getting loans for things that you don't know how you'll pay back. And as a general rule of thumb, if you can only pay back your loan or whatever on a good week, month, or year of your job, you should not borrow it. You should only borrow money that you know in worst case scenario you could always pay back. That way you won't get screwed and you won't get a deal that will put you underwater or maybe even push you to bankruptcy in the future. So huge disclaimer on that, I am not a certified financial expert or advisor. So I just want to address the people that don't want to use credit by any means. They don't want to get a loan on a car, they don't want to have credit cards, and I fully understand those type of people. But I would like to talk about how it affects you outside of borrowing money. So just to give you guys an example, if you're trying to rent a house or an apartment, landlords do look at your credit. And if your credit is not that good, they might pass you up for someone else. And it doesn't matter how much money you make. Landlords typically care more that you have a proven track record of paying back bills. And the only way you can really show that to a landlord is by having credit. And another instance of why credit's useful, even if you don't want to borrow anything in the future, is that insurance rates will look at your credit score and give you discounts if you have excellent or great credit. If you have really bad credit, your insurance rate might be 20 to 30% more expensive than the other person. And you guys could be the same age and have the same vehicle. And just because of your credit score, you're stuck paying $200, $300, $400 more than the next person. And if you are someone that wants to hopefully buy a house in the future, having good credit can make your house payment a few $100s cheaper every month. It'll save you thousands of dollars across the time span of your mortgage. And to give some context from a landlord, why a landlord would even care about someone's credit, let's say the landlord gets 2 applicants. One person has 500 credit, making $8,000 a month, and the other person has 700 credit, making $3,000 a month. If the rent is only $1,000, the landlord knows both people can pay the rent. But only the person with a 700 credit score can show on paper that they have a proven track record of paying back bills. And the landlord put a heavy investment into this property. Instead of buying the Maserati, they bought the house to use as an investment. So they want to make sure whoever they're renting it out to can 100% make rent payments on time. So let's talk about what a credit score even is, because I mentioned that a few times already, and I want to just break down in the most basic way what credit score even means. Without making it too complicated, a credit score is just a 3-digit number. It can go as high as 850 and can be at 0 or non-existent, or it may be 300, 400, 550. And it can range, depending on how long you've had credit. It can depend on how much money you have borrowed. If you ever missed a payment, it can hurt your credit. There's all that we'll get into later. But just in general, think of your credit score as your GPA. If you met a 4.0 student, that they take their school grades seriously. The same way, if you meet someone with an 800, 850, 750 credit score, financially they take it seriously and they always make their payments on time. Now I want to break down the range of credit score. We already talked about how it can go up to 850, and on the low end it could be non-existent or around 300. I'm going to break down that entire range into sections so you know why you want to move toward that 850 mark and what you even get out of it. So to start off, you're going to be around in the 300 to 580 range. So this is where typically most people start off if they've never had credit before in their life. Or you might even get demoted to this ballpark range of 300 to 580, and this is called poor credit. So if you ever miss the payment, you instantly get sent to the shadow realm of 300 to 580 credit. And in this credit range, it'll be extremely difficult to get a loan on most things. If you're trying to get a car loan, you might even have to put half of the value of the car down to even get a loan on the vehicle. So if you wanted a $10,000 car with a 300 credit score, you might need to put down $5,000, sometimes even more, to get a loan on that vehicle. So this is definitely not the range you want to be in. If you find yourself here, it's okay. You just want to take the steps that are explained later in this video to move toward the next range. And the next section is from 580 to 670. In this section, you're in the fair credit range. And that's a very nice way of saying you're not the worst, but you're not the best. You're fair. It's not a range that you want to be in, but in this range, you will start to get approved for loans. So that same $10,000 car, you might only need to put 20% down or 30% down. In many cases, it will be a requirement to put down a higher down payment when you're in the range of 580 to 670. But in this range, you will be able to still get approved for credit cards. You will be able to get approved for car loans. You might even be able to get a mortgage with this credit score. It's just not going to be favorable terms. And in my opinion, you don't really want to take loans out when you're in this credit score. You want to wait till you're at a better credit score so you could save some money in interest. We'll get into what interest is later, so keep watching. And the next section you're going to get into is the 670 to 740 credit. And this is called the good credit range. Now, in the 670 to 740 range, you are considered good credit. Yeah. And when you're at good credit, you'll be treated a lot differently than in the old fair credit range. You'll be able to get higher credit limits, you'll be able to get lower interest rates, and you'll be able to get better terms overall for this credit score. This is the credit score where you want to be at the minimum before you get a loan. Now, after you get past 740, you're going to be in a range called very good. And very good credit is from 740 to 800 credit. And all that means is that now you are treated almost like royalty. This is the second best credit score range to be in. You don't really have to worry about getting approved for much. As long as nothing crazy is on your credit report, you will be okay to finance whatever you want. As long as your income supports what you're trying to finance, you'll be allowed to get pretty much whatever vehicle you want, pretty much whatever house you want, and you will be able to get very nice terms for it. And what I mean by terms is just a better interest rate at a good term length that you like, with as little money out of pocket as possible. And above 800, you have the excellent credit range. This is from 800 to 850. This has all the benefits of very good credit, but now you get slightly better interest rates. So you might get 1 or 2% less interest APR on whatever you're financing. And we'll get into that very soon, so keep watching. And quite honestly, anything above 800, you're not going to get that much more benefit, but it's always nice to flex that you have an 850 credit score. So I yapped about what credit score is for a while now. Let me talk about what are the factors that even make up your credit score. Because so far, I brought up what a credit score is in the range, but what even makes a credit score go up or down? There's 5 factors. The biggest one is 35% of your credit score. So this is the biggest chunk. It's payment history. And this should be obvious. If you're a person that pays back every single month without missing, you're going to do great on this section. This is by far the most important section of your credit score. And if you do this one thing correctly, you will be fine. As long as you always make your payments on time, you're going to do great on it. This payment history part on your credit score that makes up 35%, all it means is that every month that you have a credit card, every month that you have a car loan, every month that you have a home mortgage or a personal loan, you make your monthly payments without missing. Do not miss it even once. I don't care what you have to do. Make sure you do not miss any payments on a credit card, mortgage, or a personal loan. Always make at least your minimum monthly payment. So I want you to think about your payment history as your health bar in a game. If your health always keeps taking a hit, you're not going to do well in the game. It's very hard to beat the game if your health keeps getting cut in half. Similarly, you don't want to miss payments. It's like taking shot after shot and you're not healing up. If your health is low, it's very hard to do well in the game of credit. You could do everything else wrong in the other factors that affect your credit score, but if you do this one thing, which is not missing payments, you will be okay. Your credit score will not be that bad as long as you always make your monthly payments on time. The second biggest chunk, which is about 30% of your credit score, is called your credit utilization. Another way of thinking about that is the amount owed. The amount you owe to a bank, the amount owed in total, how much you borrowed. Say you have a credit card that has a $1,000 limit and you rack up $1,000 in credit card debt. That means you borrowed the entire amount that the bank let you use. And while it may make sense to you that if the bank allowed you to use $1,000, why not use it? I get that. But when the bank sees that, they're seeing that this person is struggling financially. This person racked up their entire credit allowance and have $0 more in their bank account. That's why they're using it on credit. And for credit utilization or amounts owed, I want you to think about it like your stamina in a game. When you're playing a game and you have a stamina bar, if you use it up all the way, you're gonna struggle. You're not gonna be able to use your stamina when it's needed. So that's why you don't want to use up all your credit limit. The general rule of thumb in the credit card community, never go past 30%. So if you have a $1,000 credit limit, you only want to use about $300 at any given time. And it's okay if you go above it, just make sure you pay it off back to that 30% mark as soon as you can. Perfect world, you would always have a monthly balance of 0. It's completely fine to use your credit card and pay it off the same day. Completely fine. I do it all the time. Every few days, if my bill goes up to $200, $300, $5,000, I'll just pay it off right away. That's just me personally. You don't have to do that. You could be a normal person and just pay it monthly. I have some enjoyment of wiping out my debt to 0, so I personally love to do that. But as long as you're below that 30% utilization, you will be fine in this category of factors that affect your credit score. So the next section is called the length of your credit history. And all that means is how long have you had credit? I don't want to say this one's difficult, but in my opinion, this one is the only one that might be out of your control, because all it means is how long have you had credit for? And if you just open a credit card, your length of credit history is a month. You know, it might be two days, 2 weeks. And you have no other choice but to wait a year to show that you're doing okay in this category. Or the length of your credit, how long you've had credit. I want you to think about that like your experience bar or the character level in a game. And character level just shows that you have experience playing the game and you can tackle different adventures, you can tackle different enemies. In the same way, the longer you have credit, banks look at that and see that you have experience, you know how to use credit, you don't look as much of a risk because you're not new to the game. This category of factors that affect your credit score is about 15%. So the only way you can do well on this is if you just had credit for longer. And it's gonna suck if you just start off, you're gonna have to wait. And to just put it in perspective, if you're an 18-year-old and you just open your credit card, a year from now, when you're 19, you'll have 1 year of credit history. Whereas somebody who's 30, who opened their first credit card when they were 20 years old, had a credit age of 10 years. It may not be fair, but this is the game we play, so that's the rules. That person that opened their card 10 years ago has a credit age of 10, which is 10 times more than the 18-year-old that only had a credit card for 1 year. Now, don't get too bogged up on this. It's okay. This is only 15%. You could still have a great credit score even if this section is not that great. And like I said, there's no other choice but to wait on this. So in my opinion, it's best to get started now so your credit age can keep increasing throughout your lifetime. So the next section is about 10% of your credit score, and that's your new credit inquiries. So what does that mean? That means how many times have you applied for any type of credit in the last 2-3 years. And as far as new credit inquiries, think of that as your cool down period. Getting new credit cards, getting new loans is a powerful ability, similar to a game. And whenever you use a powerful ability, like applying for a loan, there is a cool down period. And if you abuse the game, they will put you in timeout. You can't use that ability time and time again. You can't get unlimited loans. So if you applied for 15 credit cards, your credit score is going to get hurt because of that. And the reason why this hurts your credit, it may seem unfair, but the reason why they don't really like when you keep pulling your credit is because usually people in bad financial situations, they lean on credit as a way out. So if somebody's applying for 15 credit cards, that looks like a super red flag to a bank. It looks like they're trying to use credit as a way to claw their way out of a really bad financial situation. So that's why you don't want to pull your credit all the time. You don't want to apply for loans all the time. When you're applying for a loan, you want to make sure you have very good odds of getting approved. As a person that owns a dealership, I get people all the time that know they have bad credit, but they still apply. And after they apply with us and if they get declined, they'll go to another dealership and try to get approved there. They get declined, and they do that 5 times over. And all this time, they're just hurting their credit even more. And they keep doing that month after month after month. And they don't realize every time they do this, it hurts their credit score. And the last factor that affects your credit is the credit mix. So all that means is, what different types of credit products do you have? I mean, in a video game, if you have a sword, you have a shield, you have a bow, you're showing the game that you can handle different type of monsters. If you only have a sword and a shield, you could essentially only fight targets that are right in front of you, right? But the second you get a bow, now you can handle mid-range, long-range opponents. In the same way, in the game of credit, you want to show banks that you can handle different scenarios. So they'll fully trust you more in different types of loans. And they'll trust you with higher limits. They'll trust you with lower down payments. They'll trust you with better interest rates. This all helps your credit score. Say you start your credit journey now at 20 years old, and you only have a credit card for the next 5 years. Your credit mix is only one. You only have one type of credit in use. You never shown that you can handle a car loan. You never shown that you can handle a mortgage. You never shown that you can handle a personal loan. Now, I don't want you to go get a car loan if you don't have to, just to boost yourself in this category. It's only worth about 10%. So don't go get a loan on something that you don't need just to boost yourself another 2-3% on your credit score. It's not worth it. I'm just explaining what this category is and how it affects your credit score. So someone that is losing in this category of credit mix can still win in everything else. So there might be someone that has a car, a credit card, and a mortgage, but they might not be doing so hot in the category of amounts owed. And that's a much bigger section. That's 30% of your credit score. So you might be able to lose in a few categories, but as long as you're hitting the big ones, as long as you're hitting all the payments every month, you'll be fine. You don't need an 850 credit score to have good credit. And keep in mind, if you're above a 700, you have good credit. You're pretty much qualified for any type of credit product that is offered. You can get a car loan at 700 credit score. You can get a mortgage at 700 credit score. You don't need to worry about getting to an 850, but it's always the goal that you should aim for. This is relatively pretty easy to achieve as long as you're hitting the 5 factors that affect your credit score. By this point, I am pretty sure that you've seen the word APR or interest rate and just wondered what the heck that even means. So let's start off with credit cards and what interest and APR is. For credit cards, interest and APR is pretty much the exact same thing. So we're going to talk about that in this scenario to make everything simple. So APR is the interest rate that credit card issuers will give you when you sign up for the card. So say you sign up for a card today and they tell you it's 20% APR. What does that mean? APR stands for annual percentage rate. So all that means is if you borrow a certain amount, they're going to charge you that interest rate against how much you borrow. Why do banks charge APR? Well, if they're loaning you money through a credit card, they need to make a profit off it. If they're not making a profit off it, then the whole system of banks doesn't work. They're not in the business of giving money away for free normally. So they have to charge an APR to stay in business. Okay, so let's say you have a credit card and it has a $10,000 limit and you spend $5,000 on that credit card. So you're carrying a balance of $5,000. Okay, and that $5,000 is going to be multiplied times a 20% APR. Pull out your phone, so type in 20 and hit the percentage icon. You could also type in 20 and divide it by 100. So you'll get 0.2 regardless. That's per year, 12 months. Annual means per year, which means 12 months, right? So you would have 20% over the course of a year. But what about your monthly charge? So you would just take the decimal version of the 20% rate and divide it by 12. So once you divide it by 12, you get 0.166666, okay? So you would multiply that amount by the balance you have on that credit card. So in the example I said, you have a $5,000 balance on that $10,000 limit credit card. So you multiply that by 5,000. That would get you an $83 interest charge. That means the cost of borrowing $5,000 per month will be $83 in interest. That means you will still owe the $5,000, but now as a cost of borrowing $5,000, they're going to charge you $83 every month that you keep a balance of $5,000. So if you never pay down that balance, you will forever be charged that $83. Until it is paid off, you will always pay interest on how much money you borrow on a credit card. This math also works for a car loan. This math will work for a home loan. This will work for a personal loan. So knowing how to calculate how much interest you're paying is very beneficial when you're getting into loans and credit cards. So far we've covered what credit is, the entire definition of how credit works, and we've covered who it's for, and even if you don't want to use credit, how it affects you. We covered how to calculate APR. We talked about how interest rates are charged based on the balance of the credit card at the end of the month. We talked about practical use cases of credit. We've also covered the 5 factors that affect your credit score. We talked about the 5 ranges of credit scores. We also covered the 5 ranges of credit scores and the 5 factors that make up credit scores. And if you're completely new to the world of credit, I highly recommend you rewatch this video, as knowing the basics is the most fundamental part of getting in the world of credit. Knowing the basics will help you out and save you so much money in the future. So please rewatch the video if you're still a little bit shaky on the entire topic. It took me years to understand everything I know now, so there's no shame of just taking a few extra minutes to rewatch the areas that you might be a little confused in. So now I would like to quickly touch on a few questions that were submitted to me. Someone said to me, "I'm completely new to credit. Where should I start and what should I do?" If I had to start all over, I would start off by getting the Chase Freedom Rise. It's very easy to get started with that credit card, and it is a complete game changer in the world of beginner credit cards. I made a full review video on this already. But to quickly recap, the Chase Freedom Rise completely changed how beginner credit cards are, and you don't have to lock up money like with a secured credit card. And all that means is with a secured credit card, you would have to give the bank $200, $300 in the beginning to set up your account. And then that would then become your credit limit. With the Chase Freedom Rise, you don't have to lock up your money in order to have your first credit card. So the Chase Freedom Rise is a great first credit card, and I highly recommend it to anyone that's just starting off in their credit journey. Someone else asked me, Josh, why are there so many different credit card options? This is an interesting question. We live in a capitalist economy, which simply means any bank can issue credit cards as much as they'd like. So, why are there so many different credit cards? There's so many different banks out there, and they're competing against each other for you as a customer. And different cards solve different problems. There's cashback cards, there's airline mileage cards, there's cards that's good for gas, there's cards that's good for groceries, and they solve different problems for different credit score ranges. So all that multiplied together will result in hundreds of different credit card options. So as to why there are so many different credit card options is because there's so many different types of customers and different credit cards to serve each different type of customer. That's why I highly suggest following a channel just like this. We review cards and show the drawbacks of each one, pros and cons, why you should get it, who should get it, and if there's better options out there. Someone recently asked me, which one is the best credit card? Which is honestly a very loaded question. And the reason being is it's very difficult to say this is the one best credit card on the market, because different credit cards serve different needs. So somebody that only spends money on groceries won't find value in the Amex Platinum credit card. They're not going to find value in travel credit cards. If all you spend your money on is groceries, you want to get a grocery specific credit card. A card that gives you great rewards from spending money at Walmart or Target, depending on your personal shopping needs. So that's why it's very difficult to say this one credit card is the best one on the market. Alright guys, if you like this video, please make sure to subscribe and follow for more content just like this. I'll see you guys next time.